Peter Rose, Longwood Currency Trading. It's a pretty cold early November day in 2021. We actually had our first snow squall up here on the mountain yesterday. Very light, but very revealing to the fact that winter is coming and fall has fell, and we're pretty much done with all that stuff. Interesting, because I have a long-term trade on right now that I'm about to change my mind on what the profit target is. I've had the trade for quite a while. I'm a couple of $1,000 up, a little more than that, and the profit target is set for a little bit further away than this. Not a little bit, but quite a bit more. So the issue that comes up is you should just when you have a winner, you just let it go and keep it going and add to it as it goes. Well, I've held it for quite a while. For part of that while, quite a bit of that while, it was against me and I was underwater. So now I'm doing well. It's more the result of a anomaly in the economic scene between the countries. There's interest rate negotiations and stuff going on, and some economic forces with the central banks that are coming to bear. And in the United States, I'm trading a dollar pair. Our unemployment has gone down, and there's other factors that are really increasing. The dollar index is up 143 point. It's up about 143. It's amazing, and I think the pound, which I'm on the other side of, is down an equal amount. It seems like they're parallel there, but of course when you add them together, you get these big spikes. What am I going on about here? Another issue that I find with long-term positions is that you hold them for the long time, and when you're in a profit situation and you're waiting for that thing to go, you start doubting yourself. Oh, well, maybe this is different. Maybe I should get out of this. So many times I've had positions that have been in profit that retrace, and you lose a considerable amount of it. So in this particular instance, we're sitting there with a little bit of profit the other day, and now, boom, the thing is spiking down on this news. There's going to be a retracement to counteract that. The question is, are these the big institutional investors taking advantage of the spurt in the news only to clear out their inventory so they can start going back and rebuilding their positions? And so, as disciplined as you may be in setting these profit targets and having all this theory set up, the longer you have to think about it, I think the worse off that you are. And unless you've got a lot of other positions going on, which I don't advocate, then you're focused on what this one is doing, and you're going to say, well, geez, I've got a lot invested in this. I've been in this in a long time. I've got a good profit now. I should probably just take it. Now, what other traders would say is, well, peel half of the trade off and let the rest run and see what happens. I think that's a good process, staging out, when you initiate the trade and it goes in your favor, or maybe it goes a little bit against you and then it goes in your favor and it goes on. But how often does that happen? A lot of the times these trades, even though they may go in our favor to start with, they do reverse and they go into negative territory unless you are managing a short stop. And then when it finally turns around and goes back in the direction that you wanted it to go in, right? You're going, oh man. And now you're thinking jump ball. Now you're looking at that position. Would I enter this trade now? And of course the answer to that is no. I mean, the thing has dropped has something like 30 pips or something like that, and you're going, or has gone 30 pips, and you're going, well, that's not a normal move for a 15-minute candle, right? And so there's got to be a retracement there. Of course, if you look back on charts and stuff, you'll see sustained periods where in a 1 or 2 hour period of time, price could move 200 or 300 pips. And when you're trading with some size, which I am, that makes some difference, in what you're going to do. But it also makes a big, when it turns around and does the reversal, it takes those profits that you had. You don't have profits unless you take them. But, you're in profit, and it reverses around and moves against you, and that's when all the questioning starts. It's a little different for the banks. It's not their money a lot of the times. It's client money, and they're managing client money over many trades, over many days, in order to get a particular price for their client, so that somebody who's spending $2 billion doesn't pay 18 cents more a unit for their stuff, because that could really add up to more cost to the client overall, right? So the institutional traders are trading for a different purpose, and they trade in a different way than we would as retail traders. We don't have any clients that are saying, hey, we got to get this price. And we don't have millions of dollars to do all this sophisticated averaging. And so, which smooths out the gyrations in the price that you're actually watching on the screen. And you're trading a 1 lot or 4 lot or whatever it is that you're trading. It's a little bit more dramatic in the reflection in the value of the position as this thing goes, 8 or 10 pips in either direction. You just go, what's 8 or 10 pips? When I've got a 30 pip profit target, or a 50 pip profit target, or a 150 pip profit target, what difference does it make if it's going to gyration around 10 or 15 or 20 pips? Because if you're right, you cash out big. If you're wrong, you cash out little, but you cash out. But that's not the way that our brain works. And so I think what would be good advice to hold on to that position and manage it and let it run. You envision this thing ultimately getting here. Now, it may take several weeks to get there. Well, I've been several weeks. Well, I haven't been several weeks, a few weeks in this thing, and that's just not my. It's not in my DNA to sit around and wait for something to do something. I mean, if a friend or somebody tells me they're going to do something, I expect that to be done. I don't want to hear, well, I'll get to it tomorrow, or I'll do this, or I'll do that, and in the meantime, I'm waiting around. That's not in my DNA. I don't wait around. And so if I have an entry analysis that says, again, I'm a day trader, so every now and then I'll go into these longer term trades, and so you got to change your thought process and say, well, I'm not going for 10 pips, I'm going for 50, and maybe I'll get 20 out of that, that kind of thing. Because I don't go, my intent is not to be there for weeks and weeks and weeks in a trade. Sometimes I just get stuck there, or it's in profit, and I go, well, I think it's got, maybe it'll continue to go. I just don't like all that decision process. And I can't just say, well, I've got a profit target out there, just forget it, close the trading platform down and wait for the thing to beep at me that I got taken out on my profit. Or be more rigorous about trailing my stops. I have to be very careful when I'm doing a long-term trade, because I am a day trader. So one bad long-term trade can wipe out literally months of short-term trading profits, because the dollar value is so great. So I have to be, there's a mindset that I have to change. If you are a long-term trader, you probably don't understand this, and you're going to say, well, that's short-term stuff. You know what you're doing anyway because you're trading short. I don't think there are very many long-term traders that are listening to my channel because I've made it pretty clear the advantages that I feel in the shorter time frame trading. But that doesn't mean that I shouldn't be willing to take the longer term trades when they present great opportunities. And I've got a great opportunity. In fact, I should just go and get out of the thing. What I'm going to do, take the couple of $1,000 and let it go. I don't know. So that will be something to be determined. But the point of the video is another view of your trading process when you have this profit target and it's been against you for a while, and then all of a sudden you get this big rush of movement, and then you're going, well, now it's moving in the direction that it should, and maybe I ought to hang on. Maybe you shouldn't hang on, because your entry analysis should be, if you have a good win-to-loss ratio, it means your entry analysis is good. Like right? In other words, you're making the right entry decisions. You're saying, well, I think now's the time to get in, and this is my profit target. So that if that price action goes negative on you, and then it goes positive, and it wanders around in there, and then it comes down and goes negative, and then it goes up, and it's wandering around, and then it starts moving to the profit target, and then it comes back, and then you get this sudden rush up in price, and then it starts to stagger. That's confusing for you as any trader. But you have to look at that and say, well, wait a minute. I've got a good win-to-loss ratio, but the reason for that is because when I pick the entry point, it goes in my favor and I make money. This particular trade did not go in my favor. It wandered around, and now I'm with a profit. I'm lucky rather than skillful, and so I should just take the meat off the table and wait for the next trade. That's the attitude that is probably better to have than to sit with a trade, particularly if you're a day trader, sit with that trade for a long period of time, even though maybe you went into that as a long-term trade, and go, this is just weird behavior. It's just really moved quickly out of a bad zone. That can't be retail traders accumulating their positions. It's got to be some institution that's trying to flush everybody out. Maybe I just ought to exit. So just a different way of thinking about taking those or staying in those trades where you have these anomaly price moves. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.